Jim Bianco, president of Bianco Research, has been trying to answer that question, and he joins us now with what he's come up with. So, Jim, thanks for joining us. What do you got here? What are we in for?
I think it's more of a stock market event than a bond market event. The purpose of quantitative easing has always been to kind of remove money from the Treasury market and get it other places. Now, I know that runs counter to what most people say, but every day at 11 o'clock, the Fed holds what's called permanent open market operations. Every day at 11 o'clock, the Fed buys Treasuries. All the owners of Treasuries, meaning all of us and the dealers, used to own Treasuries, and now they own cash at 11 o'clock. What do they do with that cash? It tends to go into what Wall Street calls risk-on markets, the big one being stocks. So on June 30th, the stock market loses a key support. Now, that doesn't mean it's going to decline on July 1st, but I think that's where you have to be careful, and that's where you have to watch what's going to happen with the end of QE2, and not so much with interest rates, where everybody seems to be focusing right now.
I mean, Jim, how bad, though, do you think it's going to be for stocks when QE2 ends?
Well, the question you have to ask is, let's go back to August 27th. You mentioned that a minute ago. That was Jackson Hole's speech. Since then, the stock market's up about 26, 28%, depending on which measure you use. How much of that rally can you attribute to quantitative easing, and how much of that rally could you attribute to the economy getting better and earnings getting better? I'd say a rough scale of thumb is probably half to two-thirds of that rally was the economy getting better in earnings. The other third to half, I think, was quantitative easing. So what does that mean? 10% correction, maybe 15% at the most, not the whole 28. But that's still a fairly significant correction if you're looking at those kind of numbers because of quantitative easing.
Well, we've had Doug Cliggott on, and he brought us a cool chart. I keep bringing it up over and over again for our viewers, but he looked at the Fed balance sheet, a line chart against the S&P 500, and they're highly, highly correlated. It's a pretty cool chart. I get your point of view, and actually we're bringing up the chart again for our viewers, so you can see the correlation between the size of the Fed's balance sheet and how it correlates very closely with the S&P 500. So I get what you're saying, Jim, but we talked to somebody with a different point of view, UBS Securities Chief U.S. Equity Strategist Jonathan Golub. We talked to him yesterday. He's not too concerned about the end of QE2, so we want you to listen up along with everybody else.
The Fed has done everything to tell us what's going on. They've also told you that they are wildly committed to a ton of liquidity in the system. At the end of 2012, we will have a negative real Fed funds rate. You know, we're talking about a long time that there's going to be a ton of liquidity. I don't think that this disrupts a whole lot.
Jim, doesn't he make a pretty good point there, though, in terms of what the Fed's doing and how the kind of the longer-term effects it'll have on various equity classes or various asset classes, including the equity market?
Yeah, he's right that the Fed is committed to liquidity, and that it doesn't necessarily, liquidity doesn't go away on July 1st. They just stop adding more. But the big wild card after July 1st is going to be inflation. If the Fed gets inflation, and let's define what the Fed now says inflation is, expected inflation, things like TIPS inflation break-evens or the University of Michigan inflation survey, or those things that are supposed to tell us where inflation is going to go, not looking at core inflation or headline inflation. Bernanke made that very clear 2 weeks ago at his press conference. But if expected inflation goes up, the Fed's going to be forced to reduce that liquidity. So I agree with him that as long as the liquidity is in the marketplace and the belief is it's not going away, then that 10 to 15% premium can stay. But the minute that the perception is that liquidity has to leave because we have too much inflation, that comes out of the market, and the market could be vulnerable for a stiff correction.
Is it? I mean, do you find that it's a coincidence that as soon as the Fed comes out and has a press conference explaining everything and making really clear that QE2 is going to end and QE3 isn't going to follow it, at least not immediately or in the form that we expect, that we see commodity prices start to plummet? I mean, Ben Bernanke will say that quantitative easing and commodity inflation aren't directly linked, but it sure looks like it, doesn't it?
Yeah. Two things. First of all, as far as QE3, a year ago he said the same thing, not in a press conference, but he said there would not be a QE2. QE3 is a possibility if we get weakness in the markets after July 1st and we don't have inflation. But first you have to have weakness. They're not going to announce something like that when the market's swimming along just fine. It's more like a put option. They'll exercise it on the state of weakness. As far as commodity speculation goes, I think that the Fed tries to dissuade themselves. No, we're not. We have nothing to do with commodity speculation. I think they do. I think that a lot of the margin balances that we've seen have been inspired by Fed policy. So when margin rates get raised in silver and as they did this morning or yesterday, they announced that they're going to get raised in crude oil, you see a lot of gyrations in those markets. Now, the Fed's quantitative easing is not going directly there, but it is definitely inspiring or giving, say, a tailwind to a lot of the speculation in commodities. So when he makes comments about QE2 ending, QE3, no QE3, when the exit strategy is going to go, it's going to affect commodities because that's in those markets. It's not.
Of course, a big part of the drop in commodities we saw was the increase in margin requirements, 4 times, doubling margin requirements for silver and steel. I know you're looking at commodities here because the CME hiked margin requirements for oil.
Yeah, that's right. So the CME coming out late yesterday, raising those collateral requirements for oil futures, upping the margin requirements by about 25%. Now, the reaction in oil, though, very, very different from what we saw in silver. You know, we did see a bit of a drop-off, just around 2% when the news just came out. But now, as you can see, oil is back up about 1%. You know, some of that obviously has to do with the flooding worries in Mississippi. But the market seemingly is shaking it off, which, of course, very different from what we saw in silver last week and, of course, the wild ride that commodities went on. Jim, my question to you is, you know, you've written a lot about these margin requirements from the CME and how they're affecting commodities. You particularly point out the fact that silver, you know, it took 5 margin, raises by the CME to actually have an impact on prices. What's it going to take for oil? Do you see another margin requirement coming along the way?
I certainly hope not, because I've been somewhat critical. The CME raised silver margin requirements 5 times in 10 days. Typically, they'd raise them once or twice a year. And I think what that did was it invoked a lot of havoc and chaos in the market. No one knew what their margin requirements were going to be. They were changing every other day, and that inspired the big liquidation. Now, if they want to raise margin requirements once or maybe twice over a few-week period in crude oil, I don't think that's going to be as big a deal. But if they're going to go down the road again, that they're going to raise them every Tuesday and Thursday and the following Monday until we get a giant move in the market, then we are going to have chaos in that market. So I hope they don't repeat that mistake that they did in silver, and I suspect they're not, which is why I think that that market also had a initial dip down, and it has recovered a little bit. They're not expecting, another margin requirement on Thursday.
Got it. Hey, Jim, thanks so much for joining us. Jim Bianco there, president of Bianco Research. Always a pleasure to have you on the program. We're going to take a quick break here on Bloomberg.